Every year around April 15th, I get a panicked call from someone asking if I can help lower their tax bill. And I have to always say, there's not a lot I can do at this point. Well, for those of you watching, I have some good news because there is still time to make tax moves in 2025 to help reduce your tax bill. So today I'm going to share 7 essential tax planning strategies that can help you optimize your tax situation, reduce your tax liability, and set you up for a stronger financial future, and also take into account some of the tax changes from the One Big Beautiful Bill. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. So in this video, I want to look at some ways you can reduce your taxes, but I also want to help you think strategically about taxes because sometimes the right move is to pay more in tax today to save tax down the road. Because often what we end up doing in our attempt to save money on taxes is we keep kicking the can down the road and we can end up causing a much larger tax planning situation in the future. But proper tax planning, or I should say holistic tax planning, is about looking at a larger picture, at a long time frame, and asking how can we reduce our tax bill over the long run, not just reduce taxes today. So hopefully by the end of this video, you not only have learned some strategies to save some money on taxes, but also you'll have a framework to help you think about taxes over the long run. First, when you're thinking about tax planning, you want to start with the fundamentals. And you want to develop what I call a base case. This means assessing your current tax situation. So what you want to do is take a close look at your income for the year, any deductions you might have, any significant financial events that might have happened during the year that could have an impact on your tax situation. So for example, did you sell any assets? Did you sell any Bitcoin? Did you sell any stocks or bonds? Did you sell a home? Did you get an extra large bonus, or did you receive some RSUs? Or maybe you had an unexpected medical expense, or maybe you made a very large charitable donation. So you want to get as much of that information down on paper so you can begin to think strategically about your tax situation. What you're doing is you're looking for planning opportunities, but you're also trying to get a sense of what your marginal tax rate is going to be. Your marginal tax rate is this. It's what the tax on your next dollar of income is going to be for ordinary income and also for capital gains. And remember, in 2025, the tax brackets and the standard deduction have moved again, right? They get adjusted every year for inflation. So for example, a married couple filing jointly has a standard deduction of $31,500 in 2025. For a single filer, that number is $15,750. If you are 65 or older, you also get an extra standard deduction on top of that. And then starting in 2025, there is a new federal senior deduction, which can be up to $6,000 a person. Now that amount begins to phase out once your income gets above a certain level. And so as you're doing tax planning, you want to take that into account. So if you're thinking about doing a Roth conversions, you need to ask the question, does it make sense to do the Roth conversion if it causes me to lose out on that senior bonus? It might, but you need to make sure you run the numbers. As you build your base case, you're not just thinking about what's my tax bracket. You're also asking questions like, am I close to any phase outs like this new senior deduction that could quietly take away deductions or credits if my income creeps too high? Now, some of you may want to skip ahead to the list where I talk about the ways that you can mitigate taxes, but I want to give you an example of what it looks like to create a base case. This is something that we do for our clients so that we can do proper tax planning. So before we can really plan for the future, we have to start by creating a base case. So what we're going to do is we're going to look at Jim and Pam Halpert's tax scenario. They're retired. They live in Scranton, Pennsylvania, and we're going to look at taking their last year's tax return. We're going to use that, and then we're going to create a base case for 2025. And we're going to look particularly at Roth conversions and how it might impact the senior tax deduction. So here we have Jim and Pam Halpert. One of the things we often hear is people are like, can you do more scenarios on single individuals? And one of our problems is that the software gives us some sample tax returns to upload, and they're all married couples. As I was looking at, I was like, that really is a real issue. Everything is focused on married couples. So I am sorry that this scenario is going to be a married couple, but I wanted to use a real tax return to show you how I create a base case. So what I did is we uploaded their last year's tax return, their 2024 tax return into the system. And so we can kind of just look at a quick overview. So we have Jim and Pam. They are both age 65. So they're both going to qualify for that senior deduction, that bonus deduction. They had about $200 in tax exempt interest last year, $2,100 in taxable interest, qualified dividends. They had a $50,000 IRA distribution. They didn't do any Roth conversions, and then $57,000 of Social Security income, which about $48,450 is going to be subject to tax, and then some long-term and short-term taxable gains. So that was last year's tax returns. So now what we're going to do is we're going to use the 2024 tax return as to help us create a base case for the 2025 tax return. So we're going to go ahead and copy this over, the numbers over, because it turns out it's going to be very similar. Make sure this is set for 2025. Taxable interest are the same, dividends the same. We always like to use last year's tax return because it helps us uncover income we might not have been thinking of before, right? We forgot there was dividend or interest or something. They have a bank account or a CD. And so by looking at that tax return, it helps us make sure we're not missing anything. So we're going to assume everything is basically the same. So they had $50,000 IRA distribution. They had $57,000 in Social Security income. Let's say they get a little more because of the inflation bump. So they're going to get $60,000 this year. And, the same long-term capital gains. And so the total income was a couple $1,000s more, but we noticed that their standard deduction is a little bit higher this year. So the standard deduction is $34,700. They're getting that a little bit of a senior bump. And then in addition, they get an additional $12,000 senior bonus, right? So their taxable income, even though their income is very similar, in fact, it's slightly higher in 2025, their taxable income is going to be a little over $12,000 less because of that bonus, which is great, right? So they're going to pay almost almost $1,500 less in taxes in 2025 than they did in 2024. But they've been watching my videos and they decided that they were going to do a Roth conversion. And this, by the way, is what I mean when I'm talking about creating a base case, because now we kind of have an understanding of they're in the 12% tax bracket. So we can go ahead and look at a tax report here. And we can see that Jim and Pam are going to do a Roth conversion, and they want to go up to the top of the 12% tax bracket. So we can come here and look and say there's quite a bit of room before they hit the next threshold at the top of the 12% tax bracket. So we're going to go back over here, and we've got a handy dandy, what we call a solve for minimum and max that tells us how much we can convert before we get to the next tax bracket, or before we hit the top of the 12% tax bracket. So the software is going to do some calculations for me here. So now we can see that to the top of the next tax bracket in ordinary income, there's about $26,000 that we can convert. So I'm going to now add that $26,000 Roth conversion in. But before I do that, I want to just copy this over. So we're going to copy a scenario from 2025 because I want to show you the difference in the tax, what they're going to have to pay in tax. We're going to go here, Roth conversion. We're going to do a $26,000 Roth conversion. And so now we can go down here and we can look, see what the delta is going to be, right? So they're going to do a $26,000 Roth conversion. It's going to cause about $500 more of their Social Security to be subject to tax. And then we can go down here and see it's going to cause them about $26,000 more, a little over $26,000 more in taxable income. So that Roth conversion is going to cost them around $3,000 in taxes. But they've been watching my videos and they decide, you know what, we want to be a bit more aggressive in our Roth conversions. We're going to do $50,000 this year. We're going to go up into the top, or up into the 22% tax bracket. So we're not going to go crazy, but we're going to do $50,000. So it doesn't impact the amount of their Social Security that's taxed at all. So now they have $50,000 of additional income. So we can go down here. And what we see though, is that now they just lost $2,000 of enhanced benefits. So they did about $24,000 more in Roth conversions, but they just lost out $2,000 of their enhanced senior deduction, which means their taxable income really is $52,500 more, not just an additional $50,000, right? Because now that senior discount is being backed out. And so now their effective tax rate has jumped not just 0.45%, but their effective tax rate has jumped almost And most of that jump was because of losing the senior deduction. So we have this tool called range calculator, which helps us see the impact. And so what you see is that for every dollar they convert now, because they're losing that senior deduction, every dollar they convert in the 22% tax bracket is going to cost them an additional 2.6%. So instead of being in the 22% tax bracket, in reality, they're in the 24, almost the 25% tax bracket. Now, that doesn't mean they should not do the additional Roth conversion, but they need to be aware that that additional Roth conversion is going to be more expensive than they thought it was, and they need to be sure that they're including that in their tax plan. Okay, once you've created a baseline, if you're still working, one of the easiest ways to reduce your tax bill is by maximizing your retirement contributions. So if you have a 401k or an IRA or a similar retirement account, contributing the maximum allowable amount means that you are saving more money for your future, and you could also be getting a larger tax savings today. But, and this is very important, if you choose to save taxes today and you put more money in your tax deferred account, that means you are just creating a tax problem further down the road. And that leads to one of the biggest questions that I receive. Should I continue contributing to my traditional 401k or my traditional IRA, or should I contribute to, say, my Roth 401k or my Roth IRA? And honestly, it's a complicated question to answer. But as a general rule of thumb, what I tell people is this: if your marginal tax rate is 22% or less, I would lean towards a Roth contribution over contributing to your tax deferred account. If you were in the 24% tax bracket or above, I would lean towards taking the deduction. Now, part of the reason I say this is because when I'm doing tax planning for someone in retirement, I'm often doing Roth conversions up to the top of the 22% tax bracket, and sometimes even into the 24% tax bracket, and sometimes significantly more than that, depending on their particular situation. But as a general rule of thumb, if you're in the 22% marginal tax bracket, don't take the deduction, but put it into a Roth account, Roth 401k or Roth IRA. If you're in the 24% or above, I would lean slightly more towards taking that maximum deduction, particularly if you're in a high tax state and maybe you're planning on moving to a tax-free state. But this is one of those issues that's really hard to provide kind of general rules of thumb, because some people should only convert to the top of the 12% tax bracket, right? But it really depends on your particular situation. If you have a ton of money in a tax deferred account, then this is probably great advice. If you don't have a ton of money in a tax deferred account, maybe you're only going to convert at the top of the 12% tax bracket, then it might make sense going ahead and putting money into a tax deferred account, even if you're in the 22% tax bracket. But this is one of those difficult questions you have to answer. And it's really hard to put money into a Roth 401k or Roth IRA and not to get a tax deduction, because so many people focus on saving taxes today, even though it's going to cause them a bigger tax problem and a bigger tax bill down the road. But if you just want to reduce your tax bill today, right, that is your main goal. The easiest way to do this is to maximize your retirement account. And if you're married, have your spouse maximize their account as well. That is going to help you significantly lower your tax bill this year. But again, as I said, it could also cause you a tax problem down the road. But before you make any decisions, you should work with your own professional that knows your situation. Okay, the first strategy, the first way to reduce taxes is just to maximize your tax deferred retirement accounts. It's a great way to lower your taxable income. The next strategy is something called tax loss harvesting. If some of your investments have lost value this year, and I know it's been a great year, so a lot of investments are up, but if some of your investments have lost value this year, you can sell those investments, sell that stock or that ETF, and harvest those losses. You can use those losses to do one of two things: either to offset capital gains or to reduce some of your ordinary income. If your losses exceed your gains, or you have gains that you don't want to sell, you can deduct up to $3,000 from your ordinary income in a given tax year. So let's say you do some tax loss harvesting, you made a mistake, you bought, let's say, NVIDIA at its high, and you now have a loss, right? So you sold your NVIDIA and you have a $30,000 loss, and you have no gains to offset, right? You don't want to make any other changes to your portfolio. So you have this $30,000 loss. You can deduct $3,000 from your ordinary income this year, and then you can carry that remaining 27,000 forward into future years, right? So then in the next tax year in 2026, you could deduct another 3,000. In 2027, you could deduct another 3,000, and so on, unless you have a capital gain to offset, and then you can use that entire loss. Now, one thing you want to watch out for, and underline this section if you're taking notes, watch out for wash sale rules. If it ends up being considered a wash sale, you lose the ability to deduct the losses. So in short, a wash sale disallows claiming losses if you repurchase the same or a substantially identical investment within 30 days. So if you're trading in something like Tesla and you're buying and selling Tesla and you're going in and out and you've got gains and you've got losses, you could end up disallowing the losses if you're not careful. So if you sell Tesla at a loss and then you buy it right back 10 days later because you realized, oh, I shouldn't have sold it, you're going to lose the ability to be able to deduct that loss. Now, if you haven't heard of the wash sale rule before and you're doing tax loss harvesting, you should probably pause what you're doing, go do a bit of research, or talk to a tax professional before you move forward. So the first thing you can do is tax loss harvesting. But there is a flip side. You can also do something called tax gain harvesting. So many of you have gains in your account. If you have gains in your account and you're under a certain income threshold, you may be able to harvest those gains at 0% long-term capital gains. Just to give you an example of what this looks like, if you are married filing jointly and your taxable income stays under $96,700, or if you're a single filer, $48,350, your long-term capital gains may fall into the 0% tax bracket. And honestly, it's actually significantly more than that, because you take that income bracket, but then you add your standard deduction on top of that. And for a lot of people, let's say you're a married couple and you have $130,000 in gains that you take out, you could potentially take that out completely tax free. Now, like I said, single filers, it's a lower threshold, but it's still a significant amount of money. Now, I'm not going to go too deep into this here, but one thing you can do is, let's say you have a little bit of room in your income. Let's say you earn $60,000 in a year and you are married filing jointly. And so you still have some room before you hit the top of the 0% tax bracket. You can go ahead and sell some of your appreciated positions. So let's say you bought the S&P 500, or you bought NVIDIA, or you bought something that's done well. You can go and sell that position, book the gains, take the gains out completely tax-free, and if nothing else, you can buy back that position, reset your cost basis while paying little or no taxes on the gains. Now, I know I'm going really fast here, and some of you are watching this and like, wait, did he just say I can take out like 50 or 100 plus $1,000 a year in long-term capital gains completely tax-free? The answer is yes. And I have a whole video where I talk about how you can do that completely tax-free. And so I will put a link to that video in the description, because this video is already going on too long and I need to keep moving. Okay, so first thing you can do is you can maximize your retirement account. Second thing you can do is you can do some tax loss harvesting. It's not going to necessarily save you money in taxes this year, but it can be very smart to do tax gain harvesting. Next, depending on your situation, it might make sense to defer some income into the next year or accelerate deductions in this year. So let's say, for example, you had a very high income this year, so you're going to pay a lot of money in state tax. You had a big property tax bill, you paid a lot of money in mortgage interest, and you also made a significant contribution to charity. So you are over the standard deduction, right? So you're going to itemize, not claim the standard deduction. If that's you, what you can do is see if you can pay for some expenses in December that you might have waited until January to pay for. So for example, let's say you have a property tax bill that's due January 1st. Go ahead and pay that property tax bill in December of this year so you can add it to that itemized deduction, because maybe next year you won't have the same amount of deductions. You're not going to be above the standard deduction. So go ahead, pay the tax bill this year so it can be itemized along with everything else on the list. But in addition to that, you can also bunch charitable donations. So, for example, you're charitably inclined, and let's say you give $10,000 a year to your church or your synagogue or to a nonprofit that you really believe in. So, you give $10,000 a year, but you always just claim the standard deduction because you never have enough giving to get above the threshold for itemizing. So, there's no additional tax benefit. Now, you don't give for the tax benefit, right? Most of us do not give money to charity for the tax benefit, but it would be nice if we could deduct it. So what you can do is you can open a donor advised fund. Let's say you have some highly appreciated stock, maybe in Tesla or Nvidia, and you want to get a deduction for it. What you can do is say donate $100,000 of that stock to a donor advised fund. You never realize a taxable gain on that stock, so you never have to sell it, so you never realize a gain. And so then you could potentially take a $100,000 deduction in that tax year when you donate the stock. Now, it's subject to the usual AGI limits for charitable contributions, but again, I don't want to get too in depth. So you have $100,000 in a donor advised fund. You can take the tax deduction this year, the year you put the money in that account, but then you can distribute that money to the charity of your choice whenever you want. So in our scenario, you give $10,000 a year to the organization that you're invested in, right? So you put $100,000 in 2025 into the donor advised fund. You take the deduction in 2025, right? Because you're already over the standard deduction. You take that deduction. And then you can write a check from your donor advised fund for $10,000 a year over the next 10 years to the organization of your choosing from that fund. The other interesting thing about a donor advised fund is you can invest the money inside of that donor advised fund. So you don't even have to sell that stock right away, although most people do and they'll diversify, but it can continue to grow. That fund can continue to grow. Now, you're not going to get any additional tax deductions as it grows, but it can increase the amount of money that you could ultimately give to the organizations that you care about. And so this can be really helpful, particularly in a year where you have a large tax bill and you're trying to reduce that tax bill. So let's say you're doing a large Roth conversion and you're charitably inclined. You might want to make a contribution to the donor advised fund in the same year you're doing a very large Roth conversion. Or let's say you want to get a higher deduction a particular year and you're already going to be itemizing. You're not going to itemize next year. Go ahead and take that tax deduction this year to get more benefit from that donation. We could do an entire video on giving to donor advised funds, but hopefully that at least piqued your interest if you don't know what it is, and you could begin doing research. Now, once you hit 70 and a half, you can begin doing distributions from your IRA or your tax deferred account in lieu of an RMD, and that's called a qualified charitable distribution. But that is beyond the scope of this video. Next, if you have an HSA, and if you've watched any of my videos, you know that I love health savings accounts because the money goes in is tax deductible, the growth is tax-free, and if it's spent on health expenses, the profit comes out tax-free. It's an incredibly powerful account from a tax perspective. But here's the thing to know. An HSA contribution is one of the best ways to reduce your tax bill because it's an above the line deduction, meaning you can take the deduction even if you don't itemize. Now, of course, you have to qualify to use a health savings account, but if you do have access to a health savings account, it's a great way to reduce your tax bill. Now, I know I'm going fast, but I have a lot to cover. Next, make sure you've paid enough in taxes. Now, this may seem counterintuitive, but one of the ways you can actually reduce your overall tax bill, including penalty, is by making sure you paid enough money in during the year. The U.S. tax system is a pay-as-you-go structure. Most of you pay taxes through regular withholdings from your paycheck. Your company just takes care of it and sends it to the IRS. But there are a number of people, particularly people entering retirement, who may need to make estimated tax payments quarterly, generally around these dates: January 15th, April 15th, June 15th, and September 15th. And if you're required to make an estimated quarterly tax payment and you don't, you may have to pay additional penalties and interest. Now, those interest and penalties aren't technically taxes, but they sure do make your tax bill harder. Now, I'm not going to get into all the ins and outs of estimated tax payments and how to calculate it and safe harbor rules. But what I will say is there are three groups of people who get hit by this the hardest. First are small business owners. Most small business owners have heard about this and are kind of on top of it. But if you're a small business owner, you need to know about it. The second group of people are retirees doing Roth conversions who are not having the taxes withheld. If you are converting and paying the taxes from, say, a taxable brokerage account or your savings account or a CD, you probably need to be making an estimated tax payment. And you need to make sure that you make the estimated tax payment in the quarter in which you make the Roth conversion. And this gets really confusing. Another group of people who may need to make estimated tax payments are people with RSUs or equity compensation at publicly traded companies, and the company will often default to a fairly low withholding rate. And so if you and or your spouse earn a significant amount of money, your actual marginal tax rate may be significantly higher than what's being withheld. So you can either, if you're in that situation, you either need to up the withholding at your company, or you need to make an estimated tax payment. If you fall into any of those groups, you want to make sure that you have somebody helping you think through the estimated tax payments. One of the things that we do for clients is we calculate what we believe their estimated tax payments are going to be and tell them when they should make those payments and how much those payments should be for, so they can avoid paying penalties on their Roth conversion. So I could say a lot more about estimated tax payments, but I've been going on for a while, so I'm going to get to the next thing. Next, even if you're still working, you might want to consider a Roth conversion. And this is why it's important to have a base case, right? We started talking about a base case. This is where that base case becomes important, right? You have to have a base case and a general idea of your overall tax plan. So you need to know what your marginal tax rate is going to be. So for example, in 2025, if you do your base case and you realize, look, I'm in the 22% tax bracket and I've got another $20,000 before I hit the top of that tax bracket, and you've determined you should convert to the top of the 22% tax bracket, even if you're still working, it might make sense to go ahead and do Roth conversion. In fact, I have a whole video exploring this issue and talking about how some people working should begin doing Roth conversions today because it's going to make their retirement planning much easier. Now, most clients I work with have a significant amount of money in tax-deferred accounts, traditional IRAs and 401ks, and find that it often makes sense to convert, like I said, to at least to the top of the 22% tax bracket, sometimes to the top of the 24% tax bracket, and sometimes even higher, depending on their situation. So let's say you're earning $100,000 a year and you have $1 million in your traditional IRA. It might make sense to go ahead and start converting some of that money each year to the top of the 22% tax bracket while you're still working, especially if you expect higher tax rates in the future, or if required minimum distributions later in your retirement are going to push you into a higher tax bracket. So the sooner you can start getting that money from your tax deferred account to a tax-free account, the better off many people are going to be. But many people think they need to wait until they retire and they have no earned income coming in before they do Roth conversions. But often the quicker you start the conversion in a thoughtful, planned way, the better off you are in the long run. And as I've said multiple times in this video, you want to get professional advice before you do any of these items, because there are a number of things you should consider. Because you've got to think about Medicare premiums, right? IRMA surcharges and Social Security taxation. And now you need to think about the senior tax deduction phase outs. And there's also a phase out for the SALT cap, the higher SALT cap deduction. And there's just so many different things that you need to think about. And this video is at a very high level and going very quickly, but hopefully it sparks some things that you should consider. Now, I know that was a lot and it came very quickly. I felt like I was talking quickly, but hopefully it was helpful. And if you're watching this video and you're still working, you're like, wait, did he say I should start doing Roth conversions today while I'm still working? Maybe, potentially. Here's a video where I go into that. Thanks for watching.